In my opinion, a health savings account is the most underrated retirement account most people overlook, and I'm going to talk today about why you should consider including it in your retirement plan and some things most people overlook even if they have a health savings account. So once again, my name is Taublieb. I am a financial planner. I specialize in early retirement planning before age 65. I'm the host of the Early Retirement Podcast and Vice President at Root Financial Partners. By the way, if you're looking for more tips from taxes to investments to withdrawals, this is the channel for everything early retirement related. A health savings account is triple tax-free. What does that mean for you? It's a pre-tax deduction. So if you were to contribute $5,000, to use easy round numbers, you put $5,000 in. Let's assume you make $100,000. That means you're only taxed on $95,000. So it's got that $5,000 deduction feature. On top of that, it grows tax-free. And then when you take the money out, it's tax-free as well. So it's like putting all the amazing benefits of an IRA and a Roth IRA all into one. With an IRA, you get to deduct, for example, $5,000, but in the future, you pay taxes on it. With the Roth IRA, it gives you no benefit at all today, but as it grows, it's tax-free forever. A health savings account gives you the best of both worlds. There is a caveat to HSA contributions, health savings account, and that's that 2 states don't recognize that. Unfortunately, one of them is California, the other is New Jersey. You still get a federal deduction, don't get me wrong, but a state deduction is not allowed in those 2 states. Here's the benefit most people don't remember when it comes to an HSA. By age 65, you can use these funds for non-medical expense purposes. So if you're thinking, Ari, I want to contribute to an HSA, but I just don't know what my health expenses are going to be and I don't have a ton of expenses, do I need an HSA? Well, it's like having an amazing additional retirement account that you can use for non-medical expenses after age 65. The 2023 contribution limits are $3,850 if you're an individual and $7,750 if you are a family. There is an annual catch-up contribution once you're above age 55, and that's for an additional $1,000. So if you are part of a family, that $7,750 contribution really means you can contribute $8,750 if you want to maximize your HSA benefit, assuming you're eligible. A pro tip with HSAs, any unused amounts roll over. That's different than something known as an FSA. So an HSA, a health savings account, if you contribute funds and you don't use them, wonderful. They keep growing and growing. With an FSA, a flexible savings account, it doesn't work that way. They don't roll over. So it's more of a use it or lose it. An HSA, don't have to worry about that. With an HSA, depending on the provider that you use, you can invest those funds to get them a lot of growth over time. The difference is some of them will require you to have a certain amount in cash, and you might even want that amount in cash as you're paying for things like prescriptions or massages or all these other things that HSAs are eligible to pay for tax-free as a reminder. Let's talk about eligibility. Okay, Ari, all this sounds great, but can I even do so? Am I able to contribute to an HSA? There's no income limits like an IRA or Roth IRA, where based off of where you're falling and if you're an active participant, you can or cannot contribute. In HSA, you don't have to worry about that. However, you must be covered by a high deductible health plan. It can be an HMO or a PPO, but it must be a high deductible plan, and if not, then you cannot contribute to an HSA. The minimum deductible to be able to qualify for a high deductible health plan, which means if that's the case you are eligible, is $1,500 for an individual and $3,000 for a family. If that's not the case, then you cannot contribute to an HSA. The maximum out-of-pocket expenses for a high deductible health plan, $7,500 if you're single, $15,000 for a family. Another pro tip with HSA, you can use these funds in any single year. Most people think if you've contributed to an HSA, do you have to use them that year for medical expenses? No, you can wait and use those in a future year. Here's an example. Let's assume that you have a surgery and the surgery costs you $3,000 and you decide to pay cash for that surgery. Years later, you can reimburse yourself from your HSA. You just need to make sure your HSA was opened at the time that that expense was incurred, so when that surgery was performed. Make sure to keep track of your medical expenses in a separate file. So if people are thinking through, should I have an HSA or should I not? If you're eligible, think of it like Emergency Fund 2.0. It's another way to take advantage of tax benefits, but it's also funds that you can use. And I tell you more than often, there are a lot of HSA eligible expenses. So I'm gonna send a full list. And when I say send, I'm gonna have in the description the ability to download a full list of HSA eligible expenses. I might even include them here in this video. Let's assume you build up your HSA and now it's worth $50,000. And you determine that you want to draw out of personal expenses instead of your HSA to be able to pay for a lot of major medical expenses. And let's pretend that of the $50,000 in your HSA, you leave it there, you let it keep growing, but you pay $30,000 worth of medical expenses out of your own pocket. Now, let's assume you run into some hard times. Maybe you lose a job, maybe cash flow is just not as healthy as it was before. You can pull $30,000 from your health savings account to be able to pay for those expenses. So even if those funds aren't necessarily for a health expense, once again, you're over age 65, you can use them for non-medical expenses. So it's almost like reimbursing yourself, but you're also investing those funds for growth. So you want to maximize your benefit. Here's an example of a case study with a client that I walked through. Let's look at someone who funds an HSA for just $5,000 a year. Now let's assume they do that for 20 years and they're using that $5,000 every single year for medical expenses. Now John's going to retire at age 60. Now he has to come out of pocket for any new medical expenses. So $5,000 is what he's using over 20 years. That's $100,000 that he paid for. Now let's assume he does the same thing, but he invests those funds. $5,000 a year at 8% on average, that would mean he would have $289,000, an additional $189,000. That can be used tax-free in retirement or for medical expenses. In this example, it required coming out of pocket $100,000 to have $289,000. That's a lot of extra money for your retirement. I'm going to include a list here, right here, that you can see of what you're eligible for. Examples, acupuncture, chiropractor, all these different potential avenues that you might want to use. I'm going to include that there so you can see right here a list here. I know I alluded to that earlier in the video, just putting it right here and you can see here's everything you're potentially eligible for. You can also look up 2023 Eligibility HSA Expenses and you're going to see a whole lot. So I imagine there are things here you could see a benefit from doing. Now let's assume you contribute to your HSA, but you don't end up using it for qualified medical expenses. Okay, so you pay taxes on it, but you still got tremendous growth and you got a deduction for doing so. So even if you don't use it for those qualified medical expenses before 65, you would just pay taxes on it. Almost think of it like extra IRA or 401k contributions in that way. The difference is it's like an IRA or 401k, but if you use it for health expenses, you get it tax-free. Other than that, think of it like just being able to make extra contributions to an IRA or 401k where you get a deduction, but then you pay taxes when it comes out. You still get that tax-deferred growth, so an HSA can really be this special tactic that a lot of people don't fully utilize. Here's a common question I'm asked. How can you get more money into an HSA if you don't have the cash flow to be able to contribute this year? Here's something many people don't know. You can make a one-time trustee-to-trustee transfer from your IRA to your HSA. You must be enrolled in a high-deductible health plan and eligible for a 13-month test period within the HSA. That transfer does apply to the HSA contribution limit, so you can't do this transfer and then do an additional HSA contribution. You can't double dip. So when might this be applicable? Let's say you're 55 this year and you haven't contributed to your HSA because cash flow doesn't allow for it. Well, you can move funds from your IRA to your HSA and get those funds in there this year. Between you and your employer, once again, that maximum is that $7,750. Plus, once again, you get that extra catch up if you're above age 55. So really it's $8,750 that you'd be eligible for. If you end up using them for qualified medical expenses, then it's tax-free. So with an HSA, once again, it's triple tax-free. If you don't have the cash flow to contribute, you can move funds from your IRA to your HSA. So if you use them for medical expenses, it would be completely tax-free. You don't come out of pocket, pay taxes, and then pay for those medical expenses. The downside, some states like California still tax the growth on that, so not completely beneficial. It depends on the state where you're doing this from. A few downsides to be aware of. There's always pros and cons when it comes to HSA beneficiaries, meaning if you were to pass away and your HSA is inherited, what happens there? Here's what it looks like. Number one, and this kind of goes without saying, make sure there's a beneficiary on that HSA. Let's pretend it's your spouse. If it's your spouse, some people ask me, Ari, do they need to be in a high deductible health plan to be able to use the HSA as well? No, they do not, okay? If your spouse were to inherit that, the spouse can use that HSA however they see fit and still take advantage of those tax-free benefits. But no, if they are HSA eligible, they can make contributions and add more funds to that HSA they just inherited. This is not the case if the person inheriting it is your child or a non-spouse beneficiary. The account value of the HSA becomes taxable if it's a non-spouse or your child that's inheriting these assets. And it's taxable in the year of your passing. Why do I say it like this? This means the entire account will be taxable in that 1 year. That could be a big tax bill if you can't tell. The amount taxable is reduced by any qualified expenses that the owner went through that were, of course, qualified medical expenses. However, this is a very important tax planning point to think through, especially based off of health considerations. So to summarize here, when do I recommend this? After you've contributed the maximum to your 401k. There's a lot when it comes to HSA contributions, and there's a lot that many people don't consider. The fact that you can contribute a good amount and have that be tax-free forever, it's a wonderful benefit. You get that catch-up contribution after age 55. If you don't use them for qualified medical expenses after age 65, that's okay. You can still use them for your retirement. But please know, there are a lot of different rules when it comes to whether your spouse is inheriting them or children or a non-spouse beneficiary. And so we have to be smart as we're thinking through this to make sure you are getting the most out of your HSA. All to say, if you manage your HSA well, you can set yourself up really well. An HSA is just one aspect of an early retirement, but healthcare is a big aspect. So making sure that you contribute to an HSA if you're eligible to is very important and something well worth considering. If you're looking for a custom strategy to make sure your HSA is actually dialed in as much as it should be in relation to your overall financial plan, reach out to myself and let's go through a planning process to understand what this could create for you. Once again, I love what I get to do. If this was helpful, please like this video and subscribe for more content just like this. Thank you so much for watching today's video. If you don't know, I am the host of the Early Retirement Podcast, and this is what I love doing. I help people create a custom strategy to retire early. You can always reach out to me or a member of our team here at Root, and we would be happy to walk you through our planning process to show you how we can help you get more life out of your money.